Good afternoon, everybody, and welcome to NEPC's Defined Contribution Flash Poll Results webinar. We are going to be covering the results of the poll that we conducted in June, in which we were asking plan sponsors to provide us with some comments on this COVID-19 environment that we're experiencing. I'm Ross Bremen, a member of NEPC's Defined Contribution team. I've been with NEPC since 2005, and joining me today is a colleague of mine, Dan Beaton, also a member of the Defined Contribution team, who's been with NEPC since 2012. The first few questions that we asked in our flash poll focused on identifying the type of organization that was responding and the size of the program. If you look at the results from question 1 here on slide 3, you can see that corporate plans made up about half of those responding, but we also had many responses from healthcare organizations, public entities, Taft-Hartley plans, and some others as well. So a very broad group of folks responding to the poll. In terms of the program sizes, you can see that we also had a wide range. We had several plans with less than 100 million responding, several plans with more than 10 billion responding as well, and then of course most plans somewhere in between. So a very broad group of those responding in terms of organization type and overall plan size. The first couple questions we asked, they really focused on things that the organization might be experiencing. The first question we asked, do you expect furloughs and/or layoffs in 2020? And about half the respondents said no. Due to the pandemic, my organization has changed the match formula, suspended the match, or adjusted discretionary contributions. Far and away, folks indicated no, the match was not changing. So if you think about these responses from a high level, and as you think about the overall frame of this study as we move down the path in which we're really trying to gauge, is it unprecedented times or is it really business as usual? I think for a lot of organizations, based on these first couple data points, at least so far in this pandemic, certainly things can evolve from here. But I think it's largely been business as usual in that matches have not been changed, and a lot of organizations have not experienced layoffs or furloughs. Now, having said that, there have been different types of organizations that have clearly been impacted. If the plan sponsor is in the airline industry, for example, or in the manufacturing space, there's a good chance that there have been layoffs, that the match formula has been adjusted. Certainly there are areas, certain sectors that have been much more impacted than others. As we move through the study here, Dan is going to, in just a few minutes here, he's gonna isolate different areas, the healthcare space, for example, in public. So we'll attempt to isolate some of the different groupings, so you can see some of the different behaviors, and we'll get to that in just a minute. Also, before I continue here, just want to remind folks that if you do have questions, you can type them in the question box. We're going to speak for maybe 20 minutes or so. We're hoping to spend about 30 minutes or so on the topic overall. We'll get to as many of your questions as we can. So definitely don't be shy. Feel free to type in those questions. As we continue through the results, the next couple questions focus on the CARES Act. And the first question shows that far and away less than 5% of participants were taking CARES Act distributions, coronavirus-related distributions, or CRDs. So 72% said that less than 4.9% of their participants had taken a distribution. When we then asked in the remainder of 2020, what do we expect? Do we expect the CRDs to increase, stay the same? It was really about 50, it was 50-50. If you look at the no increase at 33%, and then the folks that didn't adopt the CARES Act CRD provision at 19%, about half the respondents really see things continuing somewhere where they've been thus far, and then the other half indicating that we'll probably see some increases. Again, this was done in June, and this is an evolving situation, but I think that what this shows is that, again, for the folks, in those industries that are not, as I mentioned, the airline industries, for example, not the manufacturing industries, far and away, most participants have not taken distributions. They have stayed the course, and that, again, seemingly indicates a little bit more on the side of business as usual as opposed to unprecedented times. From an investment perspective, maybe I'll start with the second question on this page. Is the current investment menu working? Far and away, the majority said yes. 90% said yes. And so there certainly haven't been wholesale changes from an investment perspective. Perhaps not surprising to anyone is that when we asked folks, do you feel that the current COVID-19 environment has it reinforced the need for retirement income products that guarantee some level of income? The majority, 68%, said yes. And that's not really surprising. Pretty much any study that's been done over the last many, many years, plan sponsors have indicated that there is a need for retirement income products. They've indicated that longevity risk is a key driver of investment product selection. And so it's not surprising that we would see people responding yes to this question. Although when it comes down to it, we really haven't seen a lot of people adopting the products. And I suppose that could change. The Secure Act is now in place, which makes it a little bit easier to pick an insurance company for a guaranteed product. And many, many investment managers are now rolling out products. So we haven't seen huge adoption yet, but it's possible that we could in the future. In terms of investment priorities for the remainder of the year, we asked respondents to rank the following priorities, and with lower numbers, 1 being better than 5. When we did this, a couple items rose to the top, and it's kind of interesting. Right at the top, no special investment priorities, business as usual, virtually identical to consider the role of active offerings within the program. So many plan sponsors ranking business as usual right at the top, and then the active offerings within the program, that is the active passive debate that we've been witnessing really for many years. Over the last decade, passive products have done very well. A lot of people thought in the first quarter when we had the huge drawdown that active managers would finally have their moment. The belief being that virtually any strategy could go up when things were going well, but the active managers would do better when the market declined. And our observation is that it was really a mixed bag. While many investment managers, active investment managers, did well in the first quarter, many others did not. And so, with that being the case, I think we're going to continue to see the active passive conversation continuing on in the next several quarters. In terms of ranking other priorities for the remainder of the year, at the bottom of page 7 here, clearly at the top, reviewing participant communication and messaging. And so I think as we've experienced the COVID-19 environment, record keepers, plan sponsors, there's been a big priority, a big emphasis placed on communicating to participants that these are long-term assets, and it's very important to stay the course and consider your long-term circumstances. We did see increases in assets being allocated to safe investments like money market and stable value. And so I think it's important that everybody recognize that for those folks who didn't stay the course, if they had moved to safer investments during the first quarter, they would have missed out on one of the biggest market rebounds in the second quarter that we've seen in about 50 years. So I think it's important that these messages are out there, and rightly, I think record keepers and plan sponsors really focused on reiterating to folks that, hey, these are long-term assets. If you're considering something like a CARES Act distribution, really think about what you're doing, think about your circumstances before you do something rash. Otherwise, you could be harmed in the long run. Number two, in terms of priorities, consider and or review advice offerings, second on the list, but clearly a big difference between the communication ranking and advice at number two there. In addition to the questions we asked, we also asked if we had missed anything, and we included a couple of the items here at the bottom of page 8. Record keeper searches, we continue to see record keeper searches, retirement income products. To the extent that I mentioned the guaranteed products, the insurance products, folks are focused on income products more broadly, and that means that they're focused on things, really the full range of things like target date funds, income generating fixed income products, perhaps it's managed accounts. There's a full range of products to help participants ensure that they have enough retirement income before we get to the true insurance products that might be offered both in plan and out of plan. Self-directed brokerage was another one, and then legislation / regulation. I think it's fair to say that in terms of litigation, we've seen as many lawsuits in the last several months as we have really during any period in recent history. And then the folks in Washington have been very active as well. At the beginning of the year, we had the Secure Act. Then with COVID-19, we had the CARES Act. We've had the Department of Labor weigh in on private equity, ESG or socially responsible investing, and the fiduciary rule. So from a legal perspective, just a lot of things going on and a lot of things for plan sponsors to stay on top of. So I'm going to turn it to Dan here. In order to help plan sponsors get an understanding of how some of the different segments did versus one another, we created what is essentially an infographic summarizing the data that I've walked through thus far, and Dan is going to show how some of the different segments compare to these overall survey results.
Great, thanks, Ross. And Ross mentioned that we'll start with healthcare. And as we look at the infographic on the slide here, and as we all know, healthcare, the healthcare clients have led the response to COVID on the front lines and responding to that. But they did feel the impact at an organizational level. When you look at the number of plans that have had no layoffs or furloughs, it's only 38% of healthcare clients answered that they didn't have any layoffs or furloughs versus 52% in the overall survey. So much higher number layoffs happening there. It also impacted the bottom line when you look at the number of survey participants that suspended the match at 42%. So really, in terms of an impact, it was a pretty change of plans, I'm sure, for most healthcare organizations. And then in terms of the plan themselves, they did feel the impact with the match being suspended or changed. At the participant level, pretty much in line with distributions. The one notable item on the coronavirus-related distributions is the number of healthcare clients that didn't adopt the provision, slightly higher than the overall survey, which seems counterintuitive when you look at the impact on organizations. Some of that, and speaking to some of the healthcare consultants here at NEPC, could be related to logistics, just the resources that were required to respond to COVID. Prevented some planning meetings to happen, and at the time of the survey, this might have changed after that, and maybe more have adopted. So that's certainly notable. Not a huge difference, but notable when you consider how many healthcare clients were impacted with layoffs and things like that. In terms of overall expectations on distributions, healthcare seems to take more of an optimistic tone. So if you look at on the top right side of the page, you can see the expectation of increase in distributions is lower on the healthcare side, as represented by the navy blue bar, versus the overall survey. And then in terms of increasing significantly, it's 0% from healthcare clients. So we can extrapolate that there might be some optimism that the worst has already happened with their participant populations in terms of distribution. So that may be a good sign. In terms of investments, if we look at the bottom left, you can see 96%, and that's even higher than the overall survey of healthcare clients are satisfied with the investment menus. As you may know, healthcare has had a lot of M&A activity the last few years, and what that's done is it's forced healthcare organizations to reevaluate their DC investment programs and allowed them to adopt industry best practices as they reevaluate, and you can see that reflected in the numbers in terms of satisfaction with the menu. In terms of priorities for the remainder of 2020, similar to the overall survey, as Ross already touched on, healthcare is looking at the different investment items. Some of these things may have been put on hold, as I mentioned, with some of the important meetings happening in that first and second quarter being a bit delayed, and now revisiting the usual priorities of the role of active, the QDIA, and passive investments as well. On the plan side, communication and messaging, this is similar to the results of the overall survey on the healthcare side. Really, those communication plans for a lot of plans, not just healthcare, were put on hold if they weren't essential to what was going on with COVID in reaching out to participants to stay the course. A lot of these voluntary communication programs were put on hold, and now as we get to the end of 2020, those are kind of moving to the front of the line in terms of priority. If we switch to the public side, a little different view of the furloughs and layoffs. You can see 71% of public plans did not experience any layoffs or furloughs, which is a good sign in terms of the organizational structure having less of an impact, and it stands to reason that the match numbers are higher as well. So no suspension of the match for 85% of plans. This could be due in terms of a delay in terms of fiscal years, and budgets may drive that as we get closer to 2021 and revisiting those. But in terms of where they are today, or excuse me, June, when the survey was conducted, it seems to be a pretty positive impact, or less of an impact on the public side. In terms of adopting the provision, you can see public participants, excuse me, were pretty similar to the overall survey, but when you look at the 5% of participants, more than 5% participants taking withdrawal, you can see it's higher on the public side than the overall survey. Some of that may be driven by the nature of public DC plans, where they're supplemental to maybe a DB plan, and participants be more willing to withdraw money. It may not be their primary retirement savings, so they can afford to take money out a little more on the public side. Not a huge difference, but worth noting there. If we look on the right side, you can see the top right of the page in terms of expectations, public plans have a higher expectations of distributions increasing at the end of 2020. So maybe a little more pessimism, and we talked about possibly the fiscal year being a bit of a delayed impact to furloughs and layoffs on the public side, and that could be reflected in these numbers here, which are expectation for withdrawals to increase later in 2020. In terms of the investment menu, similar to what we've already covered, public plans seem to be pretty confident in line with the overall survey. We can see the priorities for the remainder of 2020 on the public side with no special priorities, which in statistically these rankings were pretty close, so not really a lot to say about that. And on the plan side, similar to the overall survey, and healthcare clients, public clients are reprioritizing communication and messaging, making sure that they do the things they planned in 2020 before COVID hit us back in February and March. So we did get a couple questions. I'm going to read these off, and we'll go through a few of them as we have time. As Ross mentioned, we're going to go to about 2:30. The first question, Ross, is about advice offerings. That was high on the priority list, and participants asking what's going on there.
Sure. So I think that with advice, managed accounts specifically during this COVID-19 environment, we're really seeing the extremes of the differing perspectives with regard to managed accounts. I think that historically, consultants generally have been a little skeptical of managed accounts, thinking of them as expensive target date funds. The idea there is that if plan participants do not provide a lot more information about their circumstances beyond their age, that the advice that they get will not be really personalized, and you'll essentially have something similar to what a target date fund generates. So there are many plan sponsors in these challenging times that are taking a look at their managed accounts and wondering, hey, are these managed accounts working? Are participants getting a lot of benefit for what they pay for? And there's a lot more information available in the marketplace today on managed accounts, usage, returns, and so forth than there used to be. So on the one hand, you have some plan sponsors that are really putting managed accounts through the paces and wondering if it makes sense even to keep the managed account program. On the flip side, given the challenges of this current environment, obviously first quarter and second quarter extremely volatile, plan sponsors are looking for ways to help their participants, and managed accounts, it's another club in the bag. And so regardless of whether managed accounts are perhaps optimal, it's another tool, it's another service that can be given to participants to help them stay the course, help them become or remain diversified during these challenging periods. It's also worth noting with managed accounts that record keepers are really pushing managed accounts right now. Record keepers have been under fire from a fee perspective for a long time, and in this current environment, it's really no different. And so, to the extent that record keepers can make or earn additional fees from managed account programs, the record keepers are also promoting managed accounts as a solution during these challenging times. So, really seeing the extreme ends of the spectrum right now with managed accounts in the COVID-19 environment.
Good. Another question here, Ross, on DC-OCIO. Is NEPC seeing a higher interest in DC-OCIO in 2020?
Yeah, it's a great question. I think that OCIO is something that has been gaining some traction in recent years. And I would say that during COVID-19, there's been probably a continuation of the trend. Certainly, as we receive RFPs from plan sponsors looking for advisors, more and more of them are asking, or I should say, continue to ask about OCIO. And so I think in the current environment, there are definitely some plan sponsors that, based on layoffs or other activities that are limiting resources, the OCIO service is a way to to do a little bit more of the heavy lifting, if you will, when it comes to fiduciary duties. I also think that to the extent that we're seeing so much litigation in the current environment, a lot of plan sponsors are wondering if there are ways that that they can just outsource a little bit more to someone to make sure that all the boxes are ticked from a fiduciary or checked from a fiduciary perspective. So I think that the trend towards OCIO, I think it is continuing, and I think some folks are looking at it a little bit more specifically because of this challenging environment.
Good. I know we're getting close to 2:30, but I got an interesting question here on would now be a good time for re-enrollment?
Yeah, that is interesting. I mean, I think the this idea that you might hit the restart button on a plan with the idea that if participants don't take action, that they'll be defaulted into target date funds, a diversified turnkey solution that would be really an excellent place to be during this this challenging environment with so much volatility. It's an interesting question to ask. I think the challenge with a re-enrollment is that so first and foremost, while a lot of our clients have done it, it's really plan sponsors that feel a little bit more parental, and so sort of right off the bat, it's not something that everybody feels comfortable with, as much as everybody acknowledges that it can lead to much better outcomes. When the re-enrollment is done, it's typically done with some sort of big plan change, like a record keeper change or a big change in the numbers and types of investment offerings. And so with that, I mean, this COVID-19 situation is, there's a lot going on already with furloughs and terminations. There's a lot going on with the CARES Act. There's already a lot of uncertainty in the marketplace. We know that from the poll that most organizations, 90-some% are happy with their lineups and they're not making wholesale changes. It seems like as good of an idea as a re-enrollment might be to help ensure that everybody stays on the right track. It is something that's a little bit more disruptive, and there's already a lot of uncertainty in the marketplace. So, I think it's the right thinking, but I think that now, at least from a perceptional perspective, participant management perspective, I think that I think many plan sponsors might think that it's not the best time to do it.
Good. And I think we have one more minute, so maybe if we do one last question here. Many managers have ESG consideration. Does anything need to be done around that?
It's a good question. We mentioned the folks in Washington, have been busy, and ESG is we have a proposed new rule that raises the bar with regard to socially responsible investing. I think that if I understand the nature of the question, managers having ESG considerations, I think the question is asking, do you have to do anything specific, or is there anything that's required or problematic because your manager is doing something from an ESG perspective? And so the thing I would say is that first and foremost, this is just a proposal. There have been 1,000 or so opinion letters, written comment letters written to the Department of Labor, many of them suggesting that that ESG factors are beneficial from a financial perspective. So I think it's too early to say that there's anything specific to do. I think for people that have managers that incorporate ESG considerations, or that they have products that are standalone and specifically identified or communicated as being socially responsible choices, I think at this point there's more to come. I think we along with others, we're watching the marketplace and the folks in Washington very closely, and I think until the rule becomes final, at this point, we can really just speculate. Obviously the concern being with the proposed rule is that the bar is being raised, and certainly with our clients, we'll have a lot more to say if the rule goes final as is, but we're not quite there yet. So we're at the end of our 30 minutes. We want to thank everybody who's participated today and for providing us with some excellent questions. So thank you again for joining us. We will make a replay of this webinar available on our website. So look for that in the future if you happen to want to go back and listen to something again, or reach out to Dan, myself, or your NEPC consultant for additional information. Thanks again and take care.